Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required. Hello and welcome to Live Squawk's Commodity Corner on Wednesday, the 29th of April, 2026. Over the next 30 minutes or so, my guests and I will get to grips with the key stories moving the commodity markets and look at the implications for investors. Maybe understandably, our focus will be on the energy sector at the moment and oil markets in particular. We're fortunate to be joined by Rory Johnston, a Toronto-based oil market researcher, the founder of Commodity Context, a lecturer at University of Toronto's Monk School of Global Affairs and Public Policy, and host of the Oil Ground Up podcast. He's also a fellow with both the Canadian Global Affairs Institute and Payne Institute for Public Policy at the Colorado School of Mines. So a much lauded expert, and I'm looking forward to this one. Right now, Rory is arguably the most cited independent oil market analyst that we have doing the rounds, having become a go-to voice during the unfolding Iran crisis. And on that note, I'd like to welcome Rory. Rory, how are you doing?
Oh, thanks so much for having me.
No, it's our pleasure.
It's been a busy couple of weeks.
Under the first understatement of the year. Right, before we get into it though, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. Live Squawk is not a licensed financial advisor, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Now, that boring stuff is out the way. We can get into it. So, like you say, it's been a busy few weeks here, really since the end of February. And I want to, as I said, we said offline, we are predominantly a financial news service, and the podcasts we produce are generally for the financial markets. But obviously, energy and the oil markets at the moment are playing a very integral part in both direction for the markets themselves and how investors view opportunity, and also from the point of view of monetary policy, fiscal policy, it's having a massive impact at the moment. So we want to get a better grounding and understanding, really, from an expert and someone as acclaimed in your field about what the real situation is and what we should really be looking at amongst all these headlines and stories. And as it was yesterday, we got a new direction really for this, and it was the UAE announcing its plans to exit OPEC plus. What are your first views on the motivation for why they did this and its potential impact really on supply and the general dynamic of what OPEC stands for?
Yeah, that was quite a surprise yesterday morning. And I had other plans, as is so often the case in this market. I have plans for the day, and then by 8 a.m. Something happens to completely derail those plans. So the UAE. Let's summarize in basically a single sentence to start. It's a massive deal for OPEC, arguably the largest single crack in the producer group since its founding. But in terms of realized market impact, it will have zero impact on the oil market until after the war ends and Hormuz is reopened. So let's kind of go through those pieces, because I think there's a lot of people that kind of look at this and say either this doesn't matter or this is really, really bearish and it's going to kind of, derail the rally that's going on. And I think both of those are wrong, because I think, again, this is massive for the structural go-forward state of the oil market and the kind of the tone and influence of OPEC going forward. But given that the UAE has already basically maxed out its production under the current constraints of Hormuz being closed, you've seen, for instance, one of the key rerouting avenues out of that have blunted some of the impact of Hormuz was, for instance, an Emirati pipeline that terminated at the blending port of Fujairah on the Gulf of Oman side of on the other side of Hormuz. But that pipeline's been maxed out, and the UAE has already shut in millions of barrels a day of capacity. It is not currently OPEC quotas that are holding back that production. So there's going to be no impact until Hormuz reopens. But this is kind of putting, drawing your line in the sand about what the post Hormuz oil market and post Hormuz Middle East and OPEC really look like.
Okay.
Why did the UAE leave OPEC, right? I think this is the question that everyone's wondering. And the key to that is that the UAE has grown production capacity by more than any other OPEC member over the past kind of 6-7 years. Relative to 2019, the UAE's recognized oil production capacity is published by the International Energy Agency, which is even lower than what they claim themselves, but I think that's just a nice third-party estimate, has risen by about 1 million barrels a day over the span of 6 or 7 years, kind of dwarfing the capacity growth of virtually any other member in OPEC. The challenge is that not all of that capacity growth has been recognized in the UAE's quotas. And quotas determine how much how much crude oil specifically, OPEC members can produce. So, I'm saying this is like the largest shock in the history of OPEC. And I think that's because the UAE is arguably the second most important member of OPEC. Even though it produces slightly less
Saudi.
oil. Yeah, right behind Saudi. So even though it produces slightly less oil than Iraq in terms of its quota, its spare capacity is massively larger and is behind only Saudi Arabia. And as a proportion of its overall production capacity, the UAE is withholding the most proportionally. So it basically wants to monetize all of that upside production capacity, and OPEC quotas have stymied its capacity to do that. I think the final thing to touch on here is that the UAE and the Emiratis are quite pissed about what has happened over the past 2 months. They have been the target of the lion's share of Iranian drone and missile attacks, notching more attacks on the UAE alone than all the rest of the Gulf countries combined. So I think that is also, if the UAE was in OPEC playing, the part of the good soldier saying, I'm going to contribute, I'm going to do my part. We're part of the GCC, or Gulf Cooperation Council Allies Network. We're part of OPEC. We have this U.S. security umbrella that's going to protect us from Iran, right? And all of a sudden, not only are they paying the cost of being an OPEC, but they're not seemingly getting the benefits of any protection. And they've kind of been on their own for a lot of this war so far. So I think all that together has kind of prompted this to say, all right, we got to do something. We got to get out of here. And in the spirit of never waste a good crisis, if this had happened outside of the war, this is all I would have been talking about for the next month. But this is all I'm going to talk about this week, and that's going to die because something else is going to happen because this news flow is crazy. So I think they want to also bury this a little bit in the Hormuz and the Iran war news flow to kind of say, like, okay, we're just going to move on.
And so this idea that decisions to exit OPEC and OPEC Plus aligns with the state's long-term strategic and economic vision, do you believe that?
I do. And I think that, the UAE wants to produce more and it wants to continue growing capacity. And the challenge with OPEC is that OPEC's system of quotas does not make that easy. One of the weird things with OPEC is that basically the quotas and production quotas and everything else are all based off what OPEC calls these production baselines. Basically, like, let's say, Saudi Arabia's production baseline is 10 million barrels a day, and it agrees to cut 1 million barrels a day of production. That means its new quota is 9 million barrels a day, right? So that baseline is really important. But those baselines are also extraordinarily, as you can imagine, political, given that they are determined by the Secretariat. So typically, when you would have seen them historically, the baselines were based off realized production. But given that the UAE has grown capacity so much over the past decade, it has it, and during that period, OPEC has basically been in one constant cutting cycle. They've never been able to demonstrate that higher production capacity, so it's never made its way into their baseline. So there's been discussions about trying to rejigger and trying to kind of realign these baselines to production capacities. But that was something that's, that was promised years ago. And the UAE is still left waiting, on yet another cutting cycle. So they're kind of, I think, fed up with how long this is taking. And they want to kind of go out their own and say, how much can we produce if not under that kind of stifling blanket of OPEC quotas?
Okay, interesting. Um, do you think this will precipitate others within the current OPEC structure to think the same way?
I think that's possible, and I think that's the fear right now. The challenge, the optimistic view, and
Mm.
I should say optimistic from OPEC's perspective, is that the UAE had the most specific complaints that no other members within OPEC have grown capacity that much. Like they don't have it. Other members don't have as much to gain from leaving. So I think that will be an inhibiting factor. That said, I think the other aspect of what's happened with OPEC over the past kind of decade, at least, has been that you've concentrated more and more power in the hands of Saudi Arabia as kind of the de facto leader of the organization.
Right.
Um, and the main member that would have pushed back on Saudi Arabia would have been the United Arab Emirates. And I think where basically Saudi wanted to cut back production in order to keep prices high, and the Emirates wanted to raise production to monetize their new capacity. So without that voice, I would assume that the OPEC is going to become even more Saudi dominated, which I think if you are a small member that feels steamrolled, that increases the kind of reason to leave. But I think also maybe, I mean, the optimistic view here as well for OPEC is that this lessens dissent and kind of allows OPEC to have a faster, more responsive, tighter policymaking framework. That's the optimistic.
Okay, so you don't see them clashing necessarily with the likes of Saudi Arabia in that sense, because it's counterproductive for both sides. But and for the smaller members, as you say, there's probably something in it to stick around with OPEC because it gives them that little bit more clout and a bit more leverage they would otherwise have, I guess.
That's exactly right. And I think, there's always this question of like, what is the point of being in OPEC anymore?
Mm.
Like once upon a time, it was, technocratic, kind of equally shared, equally burden shared, production cutting, everything else. And you got to kind of have swanky galas in fancy hotels in Vienna. And it was a big kind of political and social club with a technocratic framing and or frosting on the outside. Now it seems more than ever just kind of like a dotted line political club connecting to you to Saudi Arabia or any of the other kind of more powerful members. That more and more OPEC is not doing equal production cutting anymore. Like over the last couple of years, it's all been done by this small group of 8 members, notably of which the UAE was one. But the rest of OPEC has kind of just been, and even OPEC Plus has kind of been sitting by the sidelines doing nothing, while this group of 8 has done basically everything.
Right.
So there's less of a cost there. And I think if you're looking at there have been arguments that like members like Iraq, for instance, which is a large member of OPEC, still the second largest producer within the group
Mhm.
of the original OPEC. Russia's obviously slightly larger. But the, being part of OPEC ties you to Saudi Arabia and a very attractive source of investment flows. So I think all of this is still more political clubby, which is why you've also seen the organization broaden out to OPEC Plus, and even beyond that to non-quota observing members like Brazil, which is technically like an observing member of OPEC Plus, but doesn't have any quotas. So it's very clear that they're trying to grow this into some kind of like alternative political convening stage.
Yeah.
But, for a member like the UAE that was like stuck in the middle of it and expect to do a lot of the heavy lifting, they're like, yeah, like I think we could probably spend our time and energy better elsewhere.
Okay, that's fair enough. I want to move on then to this current situation at hand that we have, and um, just we're coming into what 60 days now of the conflict or the impasse, if you like. Now that we've stopped the actual most violent part, um, the Strait of Hormuz, we know it's 20% of the oil transport route for global energy, the global energy market. Do you think are people starting to figure out different routes, and how long and how established? How long will it take to establish those different routes to get oil flowing again, and not to the to release this pinch point that we have at the moment in the Hormuz, in the Strait of Hormuz itself? Do you see, or is there any evidence? Is there anything that's been said that suggests that, and I imagine they would be, they're starting to redirect transportation away from the region?
Yeah.
from these
So
oil producers?
yeah, so like starting with that 20 million barrel number, which is like typically the most that's roughly correct. Roughly a fifth of global oil prior to the war traveled through Hormuz. Um, there have been notable rerouting efforts, most notably by Saudi Arabia with the East-West pipeline, which basically transits basically roughly 4.5 to 5 million barrels a day of crude from the Gulf side to the Red Sea. Um, those reroutings happened pretty quickly
Right.
within the first kind of couple weeks. And so, of that 20 million barrels a day between the rerouting of Saudi and the Emirates, I mentioned that pipeline to Fujairah on the Omani coast, um, and the fact that Iran, up until very recently, was still getting the vast majority of its oil through the Strait.
Mm.
The actual net loss to supply was more like 13 million barrels a day, which is
Okay.
notably less than 20, is the
Mm.
optimistic side. On the pessimistic side, that is still by far the largest supply shock in the history of the oil market. So we have never seen a supply shock that large. And these are just straight up unproduced barrels. So basically, we would have assumed that over the past 2 months, all of the Gulf states were producing 13 million barrels a day more than they have. So the accumulated loss of that oil production currently sits around 600 million barrels. And
Right.
given the lagged restart time of these wells, you're looking at least at this stage, at least baked in around 1 billion barrels of unproduced Gulf production that we would have otherwise expected to be produced.
Wow.
That's a lot of oil. And that's the main fundamental supply loss of this market is that 13 million barrels a day times however long Hormuz remains closed.
And
So,
and
yeah, sorry.
what? Yeah, I was going to say, and so if the war was to stop today, if there was to be some sort of resolution today, the time it takes, like based on what we have and this locked in oil, is we're months away. Are we weeks or months away from any sort of realistically normalized production level and transport level for the market?
Yeah. So even once you start the restart process on these shut-in wells, and the reason that they were shut in is because they didn't have anywhere to put the oil, right? You didn't have any empty tankers. You had already filled up your domestic inventory, and there was no alternative routes to market. So
Okay.
instead of basically just spilling the crude oil onto the sand, you shut in your production. You shut in the production at the well level. That is not just flipping a switch to restart. It takes time to kind of get going again, and that time is measured in weeks to months.
Mhm.
I've been modeling it as essentially a progressive ramp over 3 months, with about 70% happening the first month, then 20%, then 10% the month after. I think
Okay.
all that together, that's how, even if basically that billion barrel number is modeled on assuming restarts start on May 1st, which at this stage feels hopelessly optimistic. And again, that was just my charitable, kind of most conservative view.
Okay.
Um, so I think that's best case scenario. Even if you were to reopen Hormuz tomorrow, it is unlikely that you would start the restart process tomorrow. And that's because it's going to take weeks to clear the current backlog of ships that are currently in Hormuz out of Hormuz. And you need to get new ships into Hormuz because, again, I was mentioning the reason that you shut in is you don't have anywhere to put the oil. So you need new empty tankers arriving in the Gulf and loading in Saudi Arabia and the Emirates, Kuwait, and Iraq, and only then will they begin to be able to restart the process. At this stage, that seems like, again, best case scenario, weeks away.
Okay.
So we're really probably not restarting at this stage, probably not restarting, those shut-in wells for like another month. So add another 400 million barrels to that billion barrel number. And, these numbers get very, very large. I think
Yeah.
people are like, well, Rory, I was told there are 8 billion barrels of stocks in the market. So 1 billion barrels, does that really matter? And they're right. There's roughly 8 billion barrels of stocks in the market. And what we mean by a stock in the stock and flow model sense is that these are barrels that have been produced, but have not yet been consumed. But there's a lot in that stockpile that we're
Right.
talking about. For instance, of the 8 billion barrels, 2 billion barrels is oil and refined products on water. So that's basically any barrels that are on a tanker between destinations.
Gotcha.
That can't be drawn down because you need barrels to be transiting the water. Same
Mm.
with barrels in pipeline, which are technically a stock. So you can sort of shave away these unusable stocks. Then you have strategic stocks and everything else. But at the end, you have commercial OECD inventories, and those are sitting at around 2.8 billion barrels. That's the real stockpile that
2.8
matters at the end of the
billion.
day. So if let's say we got to 1 billion barrels plus another 400 million barrels, that's half. If that entirely fell on OECD stocks, which it probably won't, but if it did, just proportionally, that's half the available stockpile, and that is deeply alarming. We've never hit those types of stock declines before. That would more or less guarantee prices rising to all-time highs on a nominal basis, $150, $200 a barrel.
Wow. So could Venezuela having the stockpiles that it has help to mitigate some of what we're seeing at the moment with the fears for higher oil prices? Or is it a different kind of oil? I mean, I for all my time in the city, I've understood that, Venezuela has huge amounts of reserves. Could that be tapped? With everything that Trump did with Venezuela, and that's potentially sitting there to help the situation, or am I oversimplifying things?
Unfortunately, what Venezuela has is oil in the ground, or what we would talk about as reserves or resources. Really, what we need are barrels that have been produced. And while Venezuela boasts the largest oil reserves in the world at, 300 billion barrels, its production is only really on par with like North Dakota. So it only produces, right,
That's
but like
interesting.
just more than 1 million barrels a day. This
Okay.
is part of the Trump administration's argument about the upside with Venezuela, is that if they weren't mismanaged, if they weren't sanctioned, they would have huge upside in their production, and they do. The
Mm.
challenge is that takes a lot of time, and we're talking years to get production up to any meaningfully increased level. And we do not have years. We have weeks and months to kind of try and fill this hole. So the important thing about this hole in supply, this 13 million barrels a day number, and even let's just lower it, let's shade it even further. Let's say 10. There is no way that the oil market can fill a 10 million barrel a day supply hole in the span of months or even a year or two.
Okay.
The all-time fastest, so the United States is the fastest responding source of oil supply in the market. U.S. shale, typically when we talk about oil supply globally in a conventional sense, you're talking about years, upwards of a decade between investment and production. In the U.S. shale patch, you're talking about 4 to 6 months, which is way faster, but it's still 4 to 6 months. So we have not seen any production increase from the crisis yet, and we wouldn't even, in the best case scenario, expect it for months to come. At the all-time fastest pace of U.S. production growth in 2018, U.S. total liquids production, so crude oil, natural gas liquids, everything else, rose by 2 million barrels a day year over year. And that was the fastest U.S. production ever grown. That's the fastest that any oil producer's production had grown in the history of the oil market. That was
Right.
2 million barrels a day versus we need to fill in a hole of 10 million barrels a day. So it's just
Doesn't even touch the sides.
it doesn't. It's like that. It's like that. The scene at the in Jurassic Park where the guy's in the back of the Jeep running away from the Tyrannosaurus Rex, and he's like, "Must go faster, must go faster." That's the market that we're dealing with right now. It's just not. We can't close it fast enough. So if we can't fill it with supply, and we can't draw down inventories to the bare bottom because that would break the industry, we need prices to rise to destroy demand, to kind of hit
Right.
the other side of the ledger to adjust that balance, and that's why the fundamentals, I would argue right now, are so ragingly bullish for price, is that you need to hit not just demand destruction, but deep demand destruction levels. Because normally when we talk about demand destruction, we're talking about like 1 to 2% of global demand that we need to destroy.
Yeah.
In this, we're talking about upwards of 10%. It's a very, very different story.
These are huge numbers. Do you think this does a permanent...
It's unprecedented numbers. Like that's the thing. I think a lot of people, a lot of macro folks, a lot of finance folks that peripherally follow the oil market but aren't in the weeds all day. They look at this and say, "Well, isn't this just 2022? Isn't this just X example?" And look, in 2022, everyone got freaked out, and then we actually ended the year lower than where we started. But for context, in 2022, we were worried at the peak in April of that year. The IEA published a report that said we could lose 3 million barrels a day of Russian supply. And the market freaked out. In actuality, we didn't lose 3 million barrels a day. We only lost 1 million barrels a day. So the current supply loss is more than 4 times larger. And this is the realized loss. We know we've lost it. Is already 4 times larger than the peak of feared supply loss from Russia in 2022, and more than 10 times larger than the supply we actually lost in that year. And that's why this is just a fundamentally different story. It's not about political risk. It's not about fear. It's about a realized and verifiable loss of supply in the market that is still trying to basically work its way through the system. And that's what financial markets are trying to grapple with.
Well, poorly in some instances, I think, in terms of
Arguably.
those. Yeah, you know what I mean? I mean, if this is the case, I mean, the you're looking potentially at, manufacturers in a world where AI now is becoming we're looking at, energy demand that potentially should be, growing exponentially every month, and, this blows a great big hole through that if this isn't resolved in the near future. Listen, we're coming to near the end of the episode. Are there any winners and losers then? I mean, we can guess the losers, but are there any winners from this? Does Russia, in some way, shape, or form, come out on top? Ultimately, because of what you say, there's this 10 million barrel hole there.
So I think if you're looking at winners, I think the most obvious one is Russia, as you note. That said, and both Russia, because the Trump administration had put a lot of pressure on the Russian oil industry prior to this war,
Yeah.
and had exploded discounts that were being borne by Russian barrels, and reduced the amount that India was importing and all that stuff. But through this war, all that was basically a year of progress was erased in a month.
Yeah.
And the U.S. Treasury actually like explicitly lifted sanctions on Russian oil, or for temporarily at least,
Mm.
in order to try and ease the supply shock to the market. So that's a huge winner. The rub there, the offset, is that Zelensky in Ukraine also knows this is a massive boon for Russia, and has
Mm.
dramatically ramped up attacks on Black Sea and Baltic oil export infrastructure. So on top of this massive disruption in the Middle East, we also have huge disruptions to Russian oil exports that no one can really focus on because there's the Middle East and Hormuz going on. So that's one side bit. I think the other side is that those non-OPEC producers that had been growing production, Canada, United States, Guyana, Brazil, Argentina, they all stand to benefit, at least their oil industries do, from this kind of both increase in prices for obvious reasons, and I think more structurally from this view that like maybe Asian importers are going to want to diversify, even if the Middle Eastern oil is cheapest and easiest, maybe it's a risk, right? That concentration, they're feeling the consequences of that now. So I think the longer term is a diversification of capital and investment towards Americas and non-OPEC countries away from the Middle East. But I think it's a distributional question. So I think, right now, for instance, President Trump believes the United States is a net winner of this. And again, you could make the argument that its oil industry is winning, but that's not going to stop average pump prices in the United States rising above $5 or $6. Exactly.
Yeah.
Far more people consume oil in the United States than produce it. So even if you do have a net GDP offset, the actual impact on your average voter, again, remember this is an election year, the average voter is going to not feel any of that offset and probably going to be pretty pissed about the situation.
Yeah, absolutely. And we're probably seeing that play out as well, and we'll find out in the midterms as well, like you say, being an election year. Listen, Rory, we're at the end of the episode now, but I've found this absolutely fascinating, and the scale of the issue at hand leads me to think that potentially there's fundamental changes that are going to be made to this. I mean, we're hitting up $117 a barrel for some grade of oil at the moment, and there's a lot more, forgive the pun, in the pipeline to this in terms of both factory gate price, and basic production of energy moving forward for this year at least. So I'd love to have you back on again in a couple of months just to see if we resolved anything by then, and if not, the parlous state of affairs that we're in then. But listen, Rory, thank you very much. I'm no doubt our listeners will find this very interesting, and we'd love to have you back on again. So thank you.
Thanks for having me, and happy to come back on in a couple of months to either survey the absolute apocalypse if Hormuz remains closed, or to talk about unwinding the shock should we manage to get it reopened.
Yes, we've got much more to talk about. But thank you. We'll put up all the links to where people can find your research and your content at the end. Anyone who's missed the start of this, please go back on the podcast channels, and you can find us there on the social media platforms. We're on there too. But again, thank you to Rory Johnston. Thank you very much for your participation, and thank you everyone else for listening. and we'll see you again for another episode soon. Live Squawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.